Hi, welcome to the webinar, Your Checklist for Pension Risk Transfer. My name is Greg Cunningham. I'm with the Berwyn Group. Let's introduce ourselves, the panelists from left to right. Travis, if you want to start.
Sure. Hi, everyone. My name is Travis Jones, and I'm a senior consultant at Aon, a global professional services firm specializing in risk and human capital solutions. I have about 13 years of retirement industry experience as a pension actuary. I've spent the last 8 years specializing in pension risk transfer consulting. Here at Aon, we've advised in some capacity or another on nearly 2/3 of all of the PRT premium that's changed hands over the last 2 years, and almost 150 billion in premium since 2012. So not a whole lot in this market that we haven't experienced firsthand, and I'm excited today to share some of that hard-earned knowledge with everyone.
Ellen?
Hi, good afternoon, everyone. Good morning for those of you who are outside the Eastern time zone, like where I am. Ellen Kleinstuber. I'm one of the owners and the chief actuary at Bolton, which is an employee benefits consulting firm headquartered in the Mid-Atlantic area. But we work with clients nationally. And in a few weeks, I will hit my 32nd year in actuarial consulting. And I was thinking about this as we were preparing for this webinar. I think I did my first plan termination just about 30 years ago. And I can remember literally driving out to the client's office to drop off the printed election forms for them to hand out to participants. And so I think about how things have changed in the last 3 decades. Total, I probably worked on about 15 to 20 plan terminations in total, and the majority of them have been over the last 15 years as this has become an increasing trend with plan sponsors. I work a lot with employers in the middle market. So, not as some of the jumbo transactions, but you still get into a lot of these kinds of issues that we'll talk about today. And I find that in that market, plan sponsors also need a lot of hand-holding and rely very heavily on their advisors to get them through this process. So I'm excited to be here with Travis and Ruth and share with you some of our insights.
And I'm Ruth Schau. I'm an actuary, and I've been around probably longer than the rest of the group here. I have over 35 years of retirement consulting and insurance business behind me, and I've been 3 years at Pacific Life. And it's interesting, when I moved to Pacific Life, I balanced both defined benefit and defined contribution plans, and we have an administrative and operations group that handles both. We have many years of experience supporting pension risk transfer, and we have over 250,000 annuitants at this point in our institutional division. And in general, Pacific Life wants to support financial security for plan participants in the institutional division, and of course policyholders in the other part of our insurance business. One thing we're very proud of is it's our 7th successive year as one of the world's most ethical companies. So, and like Ellen gave a little history, I did plan terminations way back. So I think this has been occurring for a long time. We have a long history in the retirement market of plan terminations. And unfortunately, some of them that I did was in the early days before DOL's interpretive bulletin 95-1 was even effective. Although I have to say the process wasn't all that different. Maybe the due diligence part was different. But we did have a 1 or 2 large failed insurers come about, and drew a lot of change to our practice, and all for the better.
Again, my name is Greg Cunningham. I'm with the Berwyn Group. I have 12 years of experience in the participant and policyholder data management. Prior to that, I have 20+ years in the financial services industry, and I focused heavily in the retirement space during that time. At Berwyn, we partner with our plan sponsors, record keepers, custodians, and insurance companies to deliver measurable outcomes on their participant data. For example, we deliver 96.5% of all deaths, and those are all validated deaths that enable your teams to start your benefit process that you have to follow after a death is reported, or in the insurance side, the claims process. We also are able to reunite over 50% of the missing participants and policyholders that you've lost contact with. We're able to find missing beneficiaries, as well as assist in cleaning up all of your participant data. And I'd like to thank the panel for jumping in with us on this. It's a terrific panel. Okay, let's start with the questions. The first question, hold on one second. This is going to Ellen. Let's start there. Let's start with the market in general. What's going on in the market that makes it an ideal time for a plan sponsor to conduct a PRT?
There's a lot of things, and they're all related to things being high, right? So interest rates have gone up significantly in the last couple of years, and that drives down the pricing to purchase annuity contracts or to pay lump sums. Our two main vehicles for doing a pension risk transfer away from the plan to either an insurance company or the participants. We have the equity markets up. They've done well in recent years. So for plans that are still invested in equities that haven't fully de-risked their assets, that's driven asset values up. We unfortunately also have PBGC premiums that are high relative to the funded status of many plans and to the PBGC's single employer system. So plan sponsors or plans are paying premium rates that range from just over $100 to nearly $800 per participant per year, and plan sponsors just aren't perceiving that the cost that they're incurring is aligned to the value of the benefit that is being received, particularly if the plan is very well funded. And then I think you throw in on top of it that there's been a fair amount of legislative and regulatory uncertainty. Some very favorable law changes that have been targeted to help plan sponsors through the recent Secure Acts and even the American Rescue Plan Act. But that adds more complexity. And then when it's challenging to get regulations out, that can add uncertainty. You put all of this together and you have a cocktail that really is appealing to plan sponsors, particularly those that have already taken the step to freeze their plans, to say, now's a good time for me to exit the system.
Travis, would you like to add something to that?
Yeah, I think Ellen did a really nice job of laying out why PRT is attractive from the plan sponsor perspective, but plan sponsor desire to transact really is only half of the equation. On the flip side of these PRT deals, insurers like Ruth and her team, they've really stepped up to answer the increasing demand. Following record-breaking years in 2022 and 2023, the PRT market has continued its positive momentum in early 2024. We actually placed nearly $15 billion of premiums in the first quarter of this year, which is the most for any first quarter in history. Insurer engagement remains really strong with 21 insurance companies that are now in the market. We see anywhere from 3 to 5 bidders per engagement on average. Generally speaking, increased insurer engagement yields better pricing, and the market has borne that out. In 2023, almost 70% of Aon's retiree-only transactions settled at a discount relative to the accounting liability that the plan sponsors were holding on their books. And we've seen that trend continue in 2024. So both sides of the market are seeing positive momentum right now, and that's coming together to really provide a really robust PRT market in general.
Thank you. Ruth, with the second quarter of 2024 being the highest PRT quarter on the books, what makes you excited or concerned about the number of transactions taking place?
Great question. Being in PRT sales, I'm excited. The more business, the more we're busy, the better. So it's all good. concerned maybe is the fact that, there is a lot coming into the market, and it's, not only us, but a lot of insurers see some crunches, and it's more time crunches and people limitations. So you've got the human capital concerns going between operations, getting new participants onboarded into, the administration systems, getting pricing. So we have a pricing team that supports us both on defined benefit and defined contribution. And so working and coordinating quite, well with both areas and looking at calendars. So the more lead time we have that something's coming, the better off we are to try to fit it in. So, we will hold spots for particularly returning clients. But it's all exciting. We get to meet new clients as we onboard them, and sometimes get to renew our relationships with return clients. So that's all good. When you think about concerns, I'd say the one big concern I have right now, and it's just more of a market perception, that these PRT deals may not be in the best interest of plan participants. And I don't believe that. I fully think that going to a strong insurance company, giving the flexibility to plan sponsors to make these decisions doesn't hurt participants. And I hope that public perception understands that they're not necessarily losing security as they move from their employer to an insurance company. In fact, they could be actually gaining even a bit more security for the long run and stability. Just thinking that insurance companies, this is our business. We are in here to manage risk.
Thanks, Ruth. Let's talk about possible financial implications of a PRT. Ellen, what should plan sponsors be thinking about? What needs to be done?
I think the first thing that comes to mind for me is you want to look at sort of two things together, right? What do you do? Where are your assets invested currently? What kind of allocation do you have? Have you already taken the step to go into a liability-driven investment strategy, or taken some other actions to move yourself away from the return-seeking investment exposure, lock in more of a fixed income allocation? And how will that change once you make the decision that you want to move forward with a PRT transaction? How are you hedging your interest rate risk? In tandem with that, you have to know where you're going to know what kind of decisions to make. So are you looking at doing a full pension risk transfer, like a plan termination, or just a partial risk transfer? Maybe it's a lump sum window to buy out some of your terminated vested participants, or are you going to transact with an insurance company to lift out just the retirees? And what does that do to the interest sensitivity of your liabilities? Because that will drive back to what you're doing with the assets. You want to think about the accounting impact, if that is something that's important to your organization. Some plan sponsors, financial accounting is the entire ballgame, and other plan sponsors, it's like, it's sort of an aside, yeah, we have to deal with it. So understand what that means and how doing a full versus a partial PRT is going to impact your financials and the timing for reporting. And then on the flip side of that, on the cash side, think about what the capital needs will be if the plan is underfunded or it's sitting right there on the cusp, and it depends on how well your annuity broker does in getting you the best pricing. Is there a timing that's optimal? Where are you going to generate that cash from if you need it? And how sensitive is your ability to move forward with a transaction to the amount of capital? So another way, what's your budget? Is it zero? Is it something more than zero? Is there a no-go number?
Thanks, Alan. Ruth, from the insurance side, looking at that, the financial implications, excuse me, could you have anything to add there?
Similar to what Ellen has said, I think, we get more involved sometimes with plan sponsors talking about buy-in versus buy-out, and which fits the goals better, maybe which is leads a softer landing for accounting implications and recognition of liabilities. But, other things I think about it too is, as plan sponsors start going down this path, what does their next plan look like? So in retirement, they need to sponsor a retirement plan. They want something, I think of the 3 R's, recruiting, retention, and retirement. And if you're getting rid of defined benefit plans, particularly if you haven't had it frozen for 10, 12, 15 years already, what does your DC plan look like? Is it the right plan going forward? What are you going to do to improve it? And I think we're finally at a cusp where you can take a DB plan, remove it, and offer extremely similar benefits in a DC plan, and almost not impact participants. They still have the same choices, and in fact maybe even more flexible. So I think there's a lot of thoughts and planning. It just adds to that planning list for plan sponsors to go into the plan design realm as well. But I think it's exciting to make these moves, because when you think of the savings long-term and maybe the lesser volatility in the markets, it may be very helpful for budgeting purposes for plan sponsors.
Thanks. I believe this is going to be our first poll question. Are you considering a PRT or de-risking in the next 12 months? If you could answer that, appreciate it. Okay, next. Travis, once a plan sponsor, oh, we get the results right out of the gate. I wasn't aware of that. Sorry about that, folks. Do we want to put that back up if possible? Okay, 20, about a quarter and a half. Between a quarter and a half, you all see it. All right, thank you. Travis, once a plan sponsor has decided to move forward with the PRT, obviously finding the key partners is important. Can you share what that process looks like?
Yeah, absolutely. So I guess for those of you in the yes column, I think there's a couple of main questions that you need to be considering right now. So the first is, who's going to run the deal? Who's going to be your deal advisor? And the second would be, who's going to be responsible for the insurer selection decision? DOL 95-1 specifically states that if you don't have the expertise internally to go out and interact with the insurance marketplace and evaluate insurance companies, then you need to hire an independent expert to assist you with that process. And there's lots of experienced deal advisors in the market. Obviously, Aon is among them. But your deal advisor is really going to project manage the entire transaction, and they're going to coordinate with all of the different stakeholders who are involved in a pension risk transfer. And it's a long list. We're going to be talking about the plan's actuary, your administrator. There are implications that we need to discuss with your investment advisor and your ERISA counsel and the plan's trustee. And of course, we have to interact with the insurance market itself, folks like Ruth and her team. So that the deal advisor is going to handle all of that. From a decision-making perspective, the selection of an insurance company is a fiduciary decision. So the plan's fiduciaries are going to be involved. Generally, that's either the investment committee, the benefits committee, somebody like that. And they're going to play a key role on the plan sponsor side. As it relates to that insurance company decision, there's also a couple of different choices that plan sponsors can make. So the first is whether or not you want to retain the decision-making authority for picking the insurance company, or if you want to outsource that authority to an independent fiduciary to make the decision on your behalf. If you're going to retain the decision-making authority in-house, you should think about whether you need to involve the full committee, or if you're going to delegate that authority down to a smaller subcommittee For very large committees, oftentimes we see the authority be delegated down to a smaller group just to make coordination and scheduling more efficient. But alternatively, plan sponsors could hire an independent fiduciary, like I said. This could be like a State Street or a fiduciary counselors, where that independent fiduciary would come in, evaluate the insurance companies on your behalf with the help of their own independent expert that they would hire. So they would take the reins, determining suitability under 95-1, and then ultimately own the selection decision of which insurance company is going to provide benefits. And this approach with an independent fiduciary is something that we really see more often for very large transactions, typically in excess of $500 million or more.
Okay. Ruth, is there anything you'd like to add to that from your perspective?
Sure. So we don't usually get, too involved in the early process, partly because, working for Pacific Life, I can't be unbiased. So where we do get involved, though, is sometimes just education. What are the options, the buy-in versus buyout, some of those discussions. And also we'll work with, Travis at Aon and other firms to go through just due diligence ahead of time. So there's usually annual due diligence meetings where we, share a lot of information about the insurance company broadly. Sometimes we do this with larger plan sponsors. They want to ask certain questions. They want to meet sometimes some of our senior leaders and, better understand certain areas of our company and security. So that's where we get involved. But other than that, there's not too much process until we're selected as an insurer.
Okay, thanks. Let's discuss data, which is a key step to the entire process. Travis, start with you again. What do you find is the most important piece with regards to data?
Yeah, so Greg, I think I put the data considerations into two groups. I mean, the first group is really just that insurance companies need and plan sponsors need to provide the bare minimum information that the insurance companies will need to underwrite and administer benefits for your participants. This is going to be things like full name, date of birth, social security number for all of your primary participants, but then also, and this is sometimes where plan sponsors have a data gap, is that information, that same information is going to be required for all of the contingent annuitants or beneficiaries for participants who are receiving joint and survivor options. And so sometimes that's an area where some data cleanup is going to be needed. As obvious as it sounds, knowing the right benefit amount and the form of payment that somebody is receiving is important. And then also, insurance companies are going to need participants' address, ideally including ZIP+4, because many insurance companies do include as part of their underwriting process geography-based mortality assumptions. So being able to provide that ZIP+4 in addition to just general correspondence with your participants as the insurance company is administering benefits, it does assist in the underwriting process. So that's really kind of the first bucket. The second bucket is what I would consider as data that's really going to be able to help you get the best pricing from the insurance companies. And this is data that's not necessarily always collected by your plan's actuary for the valuation or by the plan's administrator for the day-to-day administration, but it can have a big impact on insurance company underwriting. So these are flags or items such as, a participant's lump sum window history. Have they had an opportunity in the last 3 to 5 years to take their benefit as a single lump sum payment? Insurers view that as a potential for some adverse selection risk. An hourly versus a salaried indicator or a union indicator for your active participants. And then also just a short job description. What are the jobs that these folks are doing? And again, those last three items, generally speaking, are going to be more applicable for active employees who are being included as part of a plan termination. But to the extent that any or all of that information is available for retiree-only transactions, it certainly can go a long way to improving the pricing that you get from the insurers.
Ruth, would you like to talk about the data from your end, and then we'll have Ellen?
Sure. Clean data, as Travis was going through, I mean, is super helpful. You know, the more stable data we have without a lot of changes later helps us. I think also looking at data and understanding, you know, are there maybe medical payments going out of the plan or other things? Sometimes we are a little surprised later on. Doesn't happen too often, but to find out that payments are made or other things. So that may be another cleanup item to think through. Do we want to keep this process in the plan or take it outside of the plan? What works better for pricing? The zip +4, you know, is good. Sometimes other, you know, data elements could be helpful too. The hourly, bargaining, salaried codes, job description. Sometimes when you think about getting a benefit, say, you know, it's $2,000 a month. It's very hard to tell whether it's somebody that's worked, you know, 35 years for the company and actually is an hourly employee, or it's the CEO who was just covered for a few years, you know. So that's where zip +4 or job descriptions can help us actually analyze and produce much more targeted pricing for a client. Looking to the future too, there's one thing that, you know, it's on my personal list, I think, for data purposes. We haven't gotten there yet, but adding in cell phone numbers as another source to try to find people when we get into missing participants would be helpful. I don't think anybody's collecting this yet, but you know, it's been on my personal list for quite a while already. So just something to, you know, think about for the future.
Ellen?
Yeah, so part of my background is I spent a lot of time working in compliance and helping plan sponsors deal with things that have not gone quite right. So one of my takes on this is to think about, are there any unresolved compliance issues that affect your data that you want to resolve before termination? So certainly things like missing participants, you want to find those. Do you have terminated vested participants who are past their required beginning date and have missed required minimum distributions? How are you going to handle those? And is that something that you can take care of before the plan termination starts? Or is it something that you're going to handle as part of the plan termination? Are there any other, I'll call them skeletons in the closet that are hanging out there? You've been saying, hey, I got to deal with that. We got to deal with that. Now's the time to deal with it before you're ready to go ahead with the termination. The last thing that any of my clients who work on the HR side, who are typically where they own the data, want to have to do is go to their bosses or the finance people who have said, hey, it's time to go forward with the plan termination, and say, whoa, hold up. Another thing I think was touched on, but I want to make sure people hear, uncashed checks. Just because the custodian has written the check and sent it and taken the money out of the trust account doesn't necessarily mean that that check has been cashed. And I've seen some, you know, little mini chaos created late in the process when a plan sponsor is going to close out their trust account, and all of a sudden the custodian says, what do you want me to do with all these checks that are sitting over here in the payment, in the, you know, the float account? And they're like, well, what do you mean? So make sure you understand what's going on with those. And then my last part, a lot of people won't think of this as data, but it drives the data going forward. Don't forget about your plan documents. Make sure they are up to date. Or do you have all your required amendments in place? Are there any compliance issues to deal with there? And then think about any voluntary amendments that you want to make. So things like eliminating complex plan provisions that are no longer relevant or obsolete or have significant value, where you don't have the data to administer it. If you don't have it, the insurance company is not going to have it. But if they have to price it, they're going to need that data. Elimination of redundant payment forms. I have a client that I'm working with that has almost 30 different optional payment forms. And, you know, it's not that we won't find an insurer that wants to take it, but who wants to take a plan with 30 payment forms? Are there options to whittle those down under the rules that the IRS has set forth? So just making sure you have the entirety of your plan put together, all of the data, all of the information. The insurers don't want the plan document. They want you to summarize that, but you need to make sure that your document is in good order so that when you're taking the plan and you're handing it off to an insurer, that you're handing them something that they're going to want to pick up.
Thanks, Ellen. This is the area of the PRT that the Berwyn Group, this is our sandbox that we play in, the data. We give you the life status, or if they're deceased, from the plan sponsor. So they're going to get the best rate they can from the insurance company, and we carry that forward to the insurance company going for years. We clean up, we find missing participant data, we find their missing addresses. We actually have a treasury management process that cleans up stale dated ERISA checks. We can do all the from soup to nuts, and we'd be happy to talk to anyone on that. But thank you for the answer. Just had to have a shameless plug there. So if we move on, Travis, what steps are important to take to ensure you're doing what is best for the participant or the policyholder?
Yeah, as we think about the process that governs these PRT transactions, Greg, ERISA is really the only legal precedent that we have, but outside of, doing what's in the best interest of plan participants and following the plan documents, there's really not a lot in the ERISA fiduciary standards that are overly specific to PRT transactions. And that's where the guidance from Department of Labor Interpretive Bulletin 95-1 comes in. So as a plan fiduciary that's looking to execute a PRT, DOL 95-1 says there's really 6 items that you need to specifically look at, 4 of which are related to insurance company financials, and the other 2 are related to participant protections. So, looking at the lines of business that an insurance company operates in, are they a monoline business, or do they have a well-diversified business portfolio? We need to look at the size of their balance sheet relative to the size of the liability that you're trying to place with them. We don't want the plan sponsor's liability to represent too much of their overall liabilities. If for some reason they made some sort of a pricing mistake or had adverse experience on your plan, we don't want that to cause them to get into any financial distress. We need to look at the quality and diversification of their investment portfolio, and we need to look at the levels of capital that they're holding. The risk-based capital standards came out of the wake of the insurance company failures in the early 90s, most notably Executive Life, and those standards have done a really good job of making sure that insurance companies are well capitalized, very different from a pension plan, which can operate at, say, 80 or 90% funded. Insurance companies always have to be 100% funded. And in fact, they've got to be holding a certain level of excess capital on their balance sheet in case the investment bets or the underwriting they did has some adverse experience. And if they are holding below that level of required surplus, they can potentially even lose control of their business from the regulators. So really have done a great job of keeping insurance companies honest and healthy, and haven't seen any PRT failures of insurance companies since the advent of those risk-based capital standards. And then the last 2 items under 95-1, which are participant protections, we did look at the levels of protection afforded by state guarantee associations, and then also the levels of participant protection based on the account structure that's being written, whether it's a general account or a separate account. So those are the best places to start. But we think here at Aon there's some factors that go above and beyond 95-1 that certainly need to be taken a look at to make sure that you're doing what's in the best interest of your participant or the policyholder. And so that's going to be things like understanding the organizational structure of the insurance company rather than just looking at the issuing entity. Understanding what their experience is in this market. Have they been in this market for 3 years or 30 years? That does make a considerable level of difference. And then also, we want to make sure that the insurance companies have the administrative capabilities to ensure a smooth transition. We like to believe that our participants today are getting great levels of service from the current administrators. So we want to make sure that that level of service continues on at the insurance company. So those are some things that we bring into the discussion that are not specifically outlined in 95-1. And the final parting shot that I'll say here is just remember, as it relates to doing what's in the best interest of your plan participants, it's important to know that you have a fiduciary obligation not only to the participants that are transitioning over to the insurance company, but you also have a fiduciary obligation to the participants that are remaining with the pension plan in the case of a retiree lift out. And so you're going to be needing to look at things like what are the impacts of the PRT on the plan's funded status pre and post transaction. Do we need to make any contributions to the plan to maintain that funded status? Do we need to change any of the investment allocations to make sure that we're handling things appropriately based on the new liability profile? So a lot of things to also consider for those that are staying with the plan to make sure that they're going to have a good outcome as well.
Thanks, Travis. Ruth, from an insurance perspective, the participants are now policy holders, right? Do you have anything else to add to that?
Yeah, once we've been selected, we work very closely with the plan sponsor to make sure data, information, the timing of letters, informing the participants and everything is coordinated well, and really try to onboard the participants. If it's retirees, it's fairly easy. They just continually get their check. We want to make sure there is no break in timing. So, data and planning and who's providing the last check from the sponsor side and when does ours start. So all of that happens. It ends up being very seamless for the plan participant. In other areas when we have deferred lives, they need to know who to call when they're ready to start their benefits. And so we want to make sure they've got the right information. We've updated our administration operations a few years ago already, and just to allow more flexibility. People can do some of this online now. They don't have to call in, or if they want to call in, they can. So it's a little bit of dual functionality, but we know participants are usually very selective in which way they'd rather provide us information. So we're trying to be much more flexible to participant needs, and that will probably continue forever. We want the participants to have a good experience. So, we're just watching, what does the market demand and trying to meet needs.
Thanks. Thanks, Ruth. Ellen, from a participant or beneficiary perspective, what do you see as the pros and the cons to a PRT?
Yeah, and unfortunately, the cons are what get most of the attention. So I think you have participants that are going to be concerned about the security of their benefit, right? They don't like change, and especially when it comes to their finances and their retirement security. They understand their employer having responsibility for providing their benefit. And there's some uncertainty if this is going to go to an insurance company. And it's ironic, right? Because these insurance companies are professionals at taking on these obligations. You heard from Ruth, this is what they do, yet it still might raise suspicion. Tying back to some of the things that Travis and Ruth talked about, I've had plan sponsors look at as another factor in, like, they get down to the very end to say, okay, I've got two I'm picking from, who am I going to pick? And I've seen plan sponsors on more than one occasion look at either reputation in the marketplace or whether this is a household name insurer. If I'm choosing between everybody's heard of us and hey, we're the new guys, sometimes plan sponsors will go with hey, if everyone's heard of us, because it will feel more comforting to their plan sponsors to have this big name. On the other hand, I've had sponsors go the other way because they were with hey, everybody's heard of us, and in a completely unrelated line of business, and the participants didn't have a good experience with it. That company may do phenomenal in the annuity area, but they might stay away from it. So there's a lot of things that go into managing some of the discomfort that participants might have or some of the anxiety that they may have. For active employees, they may hear my plan is terminating and start to get concerned over the financial health of their employer. And is this some sort of sign that there's bigger issues going on? Could that jeopardize their job, their livelihood, their ongoing finances? So a lot of it is just taking the right steps proactively to think about how you message this to employees and participants where it's feasible, maybe have meetings for your active employees. I have a client I worked with recently. They've been frozen for a very long time. They have a manageable group of 30 or so remaining active participants. And they went and met individually with them and let them know when the communication was coming out. So they got that audience to express any questions. On the pro side, I'll go back to, this is what insurers do. So one of the benefits to participants is that they're taking this obligation to pay benefits and transferring it over to someone whose job it is to do this. The job isn't to make widgets or consult on that or sell this. It is to insure pension benefits. They're very highly regulated, even more so than private companies. They have a state guarantee association coverage that replaces the PBGC insurance, and maybe that's not dollar for dollar, but given that I think there's a very low likelihood based on all of the rigorous analysis that Travis talked about under DOL 95-1, the likelihood is so low that that state guaranteed reinsurance coverage is ever going to be needed. I think that's less of a concern, and the more that can be done to help plan participants understand what this is going to look like going forward, that their benefit is secure, and that there is a very structured process around this, will help ease some of those nerves.
Travis, would you like to add something there?
Yeah, I mean, I think Ellen hit on a lot of really great information. I think a couple of quick parting shots. I would say, first, there's no action required by the participant for, a lift out PRT. And you could argue that may be a pro or a con, but, from a participant perspective, it is very seamless. The only difference that they're going to notice is the watermark on the check is coming from a different spot. You may get pickups in, administrative capabilities, as Ruth talked about. This really is something that's evolving, but it's part of the daily fabric for the insurance companies, and they're very focused on that participant experience from an administrative perspective. And then lastly, not all plans that are out there have PBGC coverage. There are a lot of church plans out there that do not have any coverage from the Pension Benefit Guarantee Corporation. So a risk transfer, whether it be as part of a plan termination or for a retiree lift out, is actually additive in terms of protection of their benefits. Not only are you moving to what is probably a more stable institution at the insurance company relative to the plan sponsor, you're picking up that state guarantee association coverage.
Thanks, Travis. Ruth, on the legal standpoint, do you see or expect any changes on the horizon?
No changes. Nothing ever happens in our world.
Nothing recent anyway.
Yeah, I live in utopia, and there will be no changes ever. It's really hard to say. I do think we have a great process under 95-1. It's led to a lot of stability. When it was created, there was a lot of instability in this PRT world at that point. And there hasn't been an insurer that's failed since 95-1 came through that are involved in this pension risk transfer business. So the safety of it is already existing. It's created. I don't know that changes will create any more stability than is already present. On the other hand, of course, there will be some changes, whether it's maybe the process of how the insurer gets selected. Maybe there'll be a few more check boxes in due diligence that needs to be done. But I do think we're in a little bit of a year of change. We're expecting the new 95-1, whatever that gets labeled, if it ever gets released by the Department of Labor. And then there's some lawsuits out there that also could, maybe change some processes. It's hard to know at this point, but I can't say I expect anything in particular, but I expect change.
Thanks. Ellen, would you like to add anything there?
Yeah, I'm hearing some of and monitoring a lot of the same things that Ruth is. There's legislators are looking at some of the offshore reinsurance arrangements. I think that's part of you know, sort of separate from the lawsuits there were that Ruth alluded to. And then, you know, I interact a lot with different regulators at the PBGC, IRS, Treasury, DOL, and they are all very interested in what's going on in the pension risk transfer market. You know, DOL obviously coming from the fiduciary side of it and the participant protection side of it. PBGC also from the participant protection side, and then IRS and Treasury, a little bit of that and a little bit of, you know, making sure that all the boxes are being checked from a tax compliance standpoint. You know, and I think, and I'm also hearing, you know, legislators are just more interested in retirement issues, retirement security issues. The Senate Health Committee recently had some hearings. They're looking at this a lot. So, you know, I think it's on regulators' radar along with a lot of other things. So the big question is, kind of how does this rate relative to other things that they want to give attention to? I think from my perspective, just talking with regulators, I'll summarize it as the better these transactions are handled, the less regulators may feel the need to step in and be more prescriptive. So think of that from a participant perspective, right? Are they being given all of the information they need to make a decision? Are the communications clear? Are people following kind of the current rules? How much as consultants, are we being asked or driven to try to stretch the boundaries of the current rules in how we support our clients with some of these transactions? And the more comfortable that regulators are that there's not a lot going on for them to be concerned about, the less they are going to change how these transactions are regulated or reviewed.
Thanks, Ellen. The three of you, you've given us a lot of information. If we can get any additional advice or insight around the PRTs in general, what would that be? Start with Ruth, then Travis and Ellen.
I'd say, you know, knowledge and early planning. I think we've heard that a few times between Ellen and Travis and that, but I'd, you know, add to that in saying that at Pacific Life, you know, we welcome phone calls from plan sponsors sometimes to go through what are the options, just learning a little bit about it. Sometimes, yeah, consultants like Travis are on the phone with the client, just going through questions and answers and just getting some comfort of the process and of an insurance company, what everything might look like and feel like. So I'd say that's one thing. You know, again, I would be very happy to talk to, you know, plan sponsors and consultants early in the stage, just to give some comfort and insight.
Okay, thanks. Travis?
Yeah, I would say, you know, for me, Greg, it's really just making sure that you're working with an experienced partner. In light of some of the recent lawsuits we just talked about, you know, fiduciary support for the process is now more important than it ever has been. So you want to make sure that the partner you're working with is able to provide that. And then also just having a partner that understands the mechanics of the market can really improve the overall outcome for the transaction. So understanding when it's appropriate to use asset in kind premium funding, whether or not to provide mortality experience data, to provide better insurer underwriting, and just knowing, you know, the right data exclusions to make if you're looking for a retiree only transaction. Should we exclude folks that have missing data, exclude folks that have certain payment forms that are more complex to increase the number of bidders, you know, excluding New York participants that have some additional regulatory hurdles that insurance companies have to climb over. An experienced partner is able to guide you through all of those decisions to make sure that you have the best outcome possible. And obviously, we're happy here at Aon to help you with any and all of those discussions.
Ellen?
Yeah, so I think as the person who's anchoring this, I would say summarize as get your whole house in order. Right? And I think that's really the message that Travis and Ruth and I have been trying to get across through today as we go kind of through this checklist. There's a famous quote from Abe Lincoln that goes something like, if you give me 6 hours to chop down a tree, I'll use 4 of them sharpening the axe. So planning is everything. Execution is important. Planning is a big part of what's going to make you successful. So as Travis has talked about, build the right team of advisors who have experience doing this work, who have seen it all, who know what the possible road bumps are going to be that you might encounter, and what you can do proactively to avoid or minimize them and deal with them ahead of time. Have a plan for them so that you are being proactive in addressing them rather than being reactive when you go, uh-oh. You know, one of my mottos when I work with our consultants and our clients is no surprises. Right? Now, listen, there's things that are going to happen that there's no realistic way of foreseeing, but if it's possible to foresee it, see it and plan for it. And this is all part of that planning. And the last thing I have is I've heard more talk recently about bringing in outside advisors that you haven't worked with through the life of the plan. So Travis talked very well about hiring an independent fiduciary to select the insurance company, because that's not something that many plan fiduciaries have experience with. So I want to bring in someone else who really knows how to do this. Also consider possibly bringing in a non-fiduciary advisor that can serve as an extension of your executive leadership team. Just give you, not take on that fiduciary responsibility as you're going through the process up to selecting the insurer, but who can give you a second opinion on and be a sounding board on the many steps you're going to have to take and the many decisions you're going to have to make along the way that get you up to that final, okay, now I'm ready to transact moment.
Thanks, Ellen. I think we're now on to our next poll question. Are you prepared for a PRT, i.e., is your participant data accurate and up to date? All right. All right. Yes and somewhat is dominating. All right, so yes and on their way. That's good. We had a question from someone in the audience, wanted to talk about potential residual liability, particularly what they were asking if there's missing participants that are beyond the required minimum distribution age. Does anyone want to take a stab at that?
So I think from a data cleanup standpoint, there's been a number of legislative and regulatory changes recently that help make this easier to deal with. First of all, we have the pushback in the required beginning date, so we'll have a few fewer people hitting it at age 70 and a half. We'll get some now hitting at 72, 73. So that can help avoid having some unpaid required minimum distributions that haven't already incurred. For those that have the changes that the IRS and that have been enacted in the Employee Plans Compliance Resolution System, EPCRS, that allow for more self-correction of operational errors, gives plan sponsors a lot of additional tools to use in how they address these, right? So you don't necessarily have to go and apply to the IRS for approval of how you're going to do it. There's a lot more things that can be self-corrected and that give flexibility for plan sponsors, make that a lot easier to do. So I think, from my perspective, I like getting those cleaned up before I start termination, if at all possible. But if you are doing a plan termination, then if you're doing a lump sum window along with it, oftentimes if it hasn't been done already, I'll make this a parallel process to the lump sum window. So we've got the lump sum window kind of going over here, and then we're going to deal with the retirees post RBD here, see if we can get them into payment so that when we hand the plan over to an insurance company, they're just coming in as retirees. The insurer doesn't have to go and try and find them. We don't have to get the insurer bidding on and pricing out, here's retro payments that have to be made, plus a go forward unknown election. So again, cleaner we can get that group, I would say do that ahead of time.
All right. And that's something that we can give some due diligence help to in searching. Should we not be able to find them, we can give you documentation on what was done that can protect you, and I would assume the plan sponsor.
And a lot of times you'll find when you have kind of this intersects nicely with the missing participants, which fits very well into what Berwyn Group does as well. But you know, you find these folks, and then you find out that the reason they didn't collect their pension is they passed away 3 or 4 years ago. And so now you also want to go and now identify, is there a beneficiary? So is there no beneficiary benefit due under the plan, no survivor benefit? Can I just take these individuals off my pension rolls? Or do I now have to go find a surviving beneficiary so I know who to turn over to the insurance company?
Yep.
And I'm not trying to give them some unknown, unnamed person. Because Ruth, my understanding, and Travis as well, is that insurers don't really want to take unknown people.
No, and besides, if you find out later there is no benefit due, the money goes back to the plan sponsor, which sometimes is very confusing if they've terminated the plan.
Yep.
So yeah, there's a lot of reasons to do the cleanup ahead of time.
Okay, let's finish up. We got to wrap this up. We have this is our 5 steps to prepare for your pension risk transfer. Obviously, identify your team and decision makers, clean up your data, understand your options and risk associated with each, understanding transactional costs, and how will you communicate to participants. I think everyone on this panel thinks these are probably the top issues. You get those in order, you can have a better experience with your PRT process. Thank you everyone for joining us, the panel. Thank you so much.